have a panel discussion today on the role of monetary policy and financial policy on financial inclusion. The session is divided in two parts. The first part is going to be about the monetary policy, and then the second one will be on the financial policy. We roughly will have 1 hour for each segment. And I would like to introduce the speakers very briefly. So I ask the speakers to please turn on your cameras. We have 4 speakers for the monetary segment. And these are, introducing is Mr. Peter Morgan, is the Senior Consulting Economist and Vice Chair of Research for the Asian Development Bank Institute. Then we have Mr. Abdul Bashar, Executive Director of Financial Inclusion Department in Bangladesh Bank. Then we have Mr. Tamarak Monjak, Chief Representative of the Bank of Thailand London Representative Office. And finally, we have Professor Ulrich Bolz, Chair of the Center for Sustainable Finance in SOAS, University of London. So I think that this is a very topical and important topic, monetary policy. We have seen over the last, since the global financial crisis of 2008, that monetary policy really play a very, very important role in keeping the global economy stabilized. First with the 2008-2009 global financial crisis, and last year with the COVID-19 pandemic. It became really a kind of last resort instrument to keep things stable. In the global financial crisis, it was a bit more tentative, it took more time. It was a very complex situation. But finally, central banks adopted, very strong quantitative easing policies, and it really, really made a lot of impact in stabilizing the situation. But with COVID-19, it was even faster because around March 2020, when the pandemic became a reality around the world, there was a panic situation in financial markets, and it looked like there was going to be a repetition of the financial crisis of 2008. But this time the response was even faster, and the situation really turned around in probably less than a month, and the market stabilized, and the situation remained more or less stable. Of course, with a lot of troubles, around the world, with unemployment and a lot of, in a very difficult situation, nonetheless, but could have been much worse. So this is, I think, it's important. Monetary policy really is very powerful. But one questioning about the way monetary policy was conducted over the last 12, 13 years is that it created more inequality. It really led to a very big increase in the price of assets. Usually, asset owners tend to be the richer segments of society. So we have seen over the last, again, 12, 15 years, a really, really big impact, a really big increase in inequality, which is mostly driven by asset prices. So one question I ask, this is not necessarily what will be discussed, but I'm personally interested, is how a monetary policy can be conducted in order not to cause this, increase in equality effect. How can it be, more conducive towards equality? So just the question from the back of my mind, But we are going to hear from you. Before that, I would like to ask my colleague Bacharin to make a short presentation, also to motivate the discussion. Bacharin, the floor is yours.
Yes.
We hear you. Yeah, we can see the presentation.
Okay. So I just would like to take a few minutes to set the scene for this central banking segment. So okay. As we all know, central bank, they are performing a lot of the functions. And in this overview, I'm going to highlight some of the functions that probably central bank can do to promote the and also the extent that they are promoting the inclusive development. So as all of us know, the main function of the central bank is to conduct this monetary policy, including interest rate adjustment. And we argue that this indirectly benefiting inequality to the price stability, which in turn lead to job opportunity and economic growth. Also, there's a big debate on whether central bank should be concerned about the inequality impact of the monetary policy or not. And if so, what can they do? For example, whether they can communicate more clearly about the potential, even though unintended effect of monetary policy on income distribution. And the second function also to regulate the financial markets, financial institution, including the facilitating the payment system. This can also indirectly benefit inclusive development to the robust and also more competitive banking sector, for example, which potentially lead to reasonable financing costs. And the subject that we are going to address today as well, central bank as a currency issuer, to what extent this can be used to promote inclusive development. An emerging issue is a central bank digital currency, which can transform the way that people can use access to the financial inclusion with right design. Is the emerging issue. So there's probably that we can talk a lot about the design feature as well. And on the traditional function as a reserve manager, okay, this is not something that central bank has been doing much to reorient this toward financial inclusion, toward the inclusive development. A lot of the reserve is being invested in a bank deposit and monetary market instrument, which is probably has a limited potential to contribute to the inclusive growth. And the financial inclusion, this is obviously directly benefiting, as well as the financial education and also financial consumer protection. Based on this overview, okay, this is where we are going to have our speaker. So the first speaker from ADBI, we talk about financial inclusion in Asia Pacific as a whole. And then we have a colleague from the Bangladesh Bank talking about experience on how Bangladesh has been performing on this financial inclusion and consumer protection, and also followed by a colleague from the Bank of Thailand on central bank digital currency or CBDC. And also it's not really only about inclusive central banking, but also the green central banking. This is also another emerging issue, whether central bank should be concerned with green development. So many literature suggests that the answer should be yes, because climate change can affect the economy to a number of risks, physical risks. Once the cyclone hit, you have a damage to your factory, building, transition risk. Once the economy progresses from brown to green, there will be some assets which cannot be used anymore, and this occur, of course. And also liability risk as an insurance company. Once a natural disaster happens, this can incur a large liability to the financial system. And these are some of the effects that this risk could have, which potentially lead to the macroeconomic and financial instability. And for this one, we're going to have the last speaker from University of London. So, yep, I think that's just a quick overview of the session and the other content. Okay, thank you.
Thank you very much, Shirin. We are now going to start with the first speaker. Without further ado, Peter Morgan. Again, I'm happy to have you here again. ADBI has done a lot of very good work on financial inclusion, on financial policy for MSMEs. We have some collaboration in the past. But my question is the following. Before the COVID-19 pandemic, many central banks in Asia and the Pacific had introduced various policy actions to increase people's access to finance. To what extent has the pandemic shifted Asia-Pacific countries' strategies in fostering financial inclusion? And moving forward, should there be new policy priorities? Beyond national actions, in what areas can regional cooperation on financial inclusion be increased? Peter, the floor is yours.
Thanks very much, Alberto. And I'd like to thank the organizers for inviting me to this very topical conference. Let me attempt to share my screen. If it fails, please put up my presentation there, but I'll give it a shot here. Oops, that's the wrong one.
Yep.
Hold on. All right, try again. Okay. Can you see the presentation?
Yes, you can.
Okay, very good.
Please go ahead.
Okay. All right. So the title of my presentation is Central Banks and Financial Inclusion, and I will be focusing primarily on the regulatory aspects that Bachman mentioned. And also should mention that obviously in many cases, it's really, sometimes the responsibilities fall with the central bank and sometimes with the financial regulator. So effectively the focus will be really central banks and financial regulators. So just to give some background, and I really wanted to give the message that central banks are operating within a larger context of policies to promote financial inclusion and also financial education. So I'll try to provide a little bit of that background, but I'll talk about first definitions of financial inclusion. What's the status of financial inclusion in Asia? What are the barriers to financial inclusion? What are the overall strategies to promote it? And within that, what are the regulatory innovations? Then I'll talk a little bit about financial literacy and financial education, and then fintech, which is having an increasing role, and financial inclusion. And then in particular, look at some of the policy innovations that we've seen in response to COVID-19, and then make some conclusions. So there are various definitions of final conclusion. Early one from Hanig and Jansen is it aims to draw the unbanked population into the formal financial system so that they have the opportunity to access financial services ranging from savings, payments, and transfers to credit and insurance. Then Khan 2011 from Reserve Bank of India, the process of ensuring access to financial services and timely and adequate credit where needed by vulnerable groups, such as weaker sections and low-income groups, at an affordable cost. So I think that this, the key point here is not just any access, it's access at an affordable cost to appropriate products. Then from the World Bank, inclusive financial systems provide individuals and firms with greater access to resources to meet their financial needs, such as savings for retirement, investing in education, capitalizing on business opportunities, and confronting shocks. And this next chart just shows the status of financial inclusion. So on the horizontal axis, we have GDP per capita, and then on the vertical axis, the most widely used definition of financial inclusion, which is the percentage of adults with an account at a formal financial institution. The Asian countries are shown in red, so you can see overall there's a pretty good correlation with income. A lot of the Southeast Asian countries are actually relatively low in this area. Of course, Singapore way up here. And then if we look at the situation of firms, so this shows the share of small firms with a line of credit, and it's somewhat related to income, although there's a wider spread, but we can see that on the whole, the shares are not very high, something like maybe on average 30%. So there is a significant issue of lack of access to finance by medium and small firms. So what are the barriers to financial inclusion? There are many. So on the supply side, we have first market-driven ones, such as the fact that small accounts and rural branches are not economic. Firms have a lack of credit data or usable collateral and lack of appropriate products. There are regulatory barriers, such as those in terms of entry and exit to financial business, capital adequacy, and supervisor rules, which may discriminate against lending to SMEs, branch ATM requirements, ID and documentation requirements, KYC, and regulation of of the microfinance institutions, and then infrastructure, lack of convenient payment systems, and lack of financial institutions. And then on the demand side, first, lack of knowledge, and this really includes both financial literacy and digital financial literacy, which I'll talk about in a bit, but also trust in the financial system is often lacking amongst people who have less access. And of course, there's a basic lack of funds. So the strategies also are manifold. So the level of the strategy can be at the national level, the central banks and regulatory agents, also private institutions and NGOs. You have various kinds of inclusion-oriented financial institutions, such as MFIs, state banks, post office, credit cooperatives, community organizations. There are various kinds of regulatory approaches, such as proportionate regulation, market-oriented policies, and regulatory sandboxes. Innovative products and services, such as no-frills accounts, agent banking, micro branches. Innovative delivery technologies, and this is where fintech comes in, use of mobile phones, e-money, and other services, and also innovative systems to enhance credit access, such as credit databases, expansion of eligible collateral, and innovative investment vehicles, such as crowdfunding or peer-to-peer lending. So it's quite a diverse set of policies. And this next table just shows how some of these policies stack up in various countries. So here we divide them into 5 major categories: inclusive financial institutions, subsidized funding, innovative products and services, innovative delivery technologies, and various measures to enhance credit access, again, like loan guarantee programs and that sort of thing. So it's quite a range of different kinds of strategies. And if we look at the roles of the various institutions in these strategies, we have first national level financial inclusion strategies, which are more or less developed in different countries. Important roles for central banks in terms of regulation of various kinds of financial institutions and development of innovative products, also financial education programs. You also have other ministries and financial regulators involved, and in some cases, campaigns by the private sector. And so what are some of the regulatory innovations that we've seen to promote financial inclusion? First, on ID requirements, there's sort of 2 opposite directions there. The first is to ease requirements in cases where documentation is scarce. This is the so-called tiered KYC, where the KYC restrictions are generally quite light in the case of small transactions. And on the other hand, you have introductions of national ID systems, which are actually making a fair amount of progress in a number of Asian countries. And then there's promotion of access, such as linking the establishment of rural branches with new urban branches, for example, in Pakistan or Bangladesh, micro branches, sectoral lending quotas, which are used in India, development of appropriate products, such as no-frills accounts, proportionate regulation, particularly of MFIs, based on the fact that they have lower systemic risk, and again, looking at fintech, regulatory frameworks for mobile phones, e-money, and other services, and the use of regulatory sandboxes and tailored licensing regimes. And I think one of the key findings about financial inclusion policy is that you really need a coordinated approach of this so-called tripod regulation and registration of financial institutions, such as money lenders, consumer protection, again, especially in the case of money lenders who may abuse their position, then financial education. And again, this next table shows the various examples of the measures here. So the first column shows the various regulatory agents involved, which frequently are the central bank. ID-related measures. So India was a pioneer in this area, certainly, and actually most of the ASEAN countries now have some form of national ID system. Various regulations of MFIs, lending regulations such as interest rate caps, and also I think consumer protection is seen as very important in most of these countries. Now, getting on to the issue of financial literacy, I think financial literacy is very important for people to make the best use of their access to financial services. There have been a number of surveys of financial literacy, one of which is that done by the OECD and the INFE, the International Network for Financial Education. Some surveys have been done in Asia. For example, here we have a GDP per capita, again, on the horizontal scale and the financial literacy score on the vertical scale. And again, there's a pretty good correlation with income. For example, Vietnam and Cambodia score relatively low, but if you take their incomes into account, it's actually a reasonable performance. And again, we see a broad range of actors and policies in the financial education space. Central banks are quite active in a number of countries. Some countries have national financial education strategies, but other regulators and the private sector are also involved. Now, getting on to fintech, it's perceived to have great potential for financial inclusion, given the fact that smartphones are widely available, and it has an ability to deliver innovative, tailored services online. Major categories of financial services would include payments and transfers, personal finance, alternative finance, and others. And I think probably the main areas which have the most impact on financial inclusion are payments and transfers and alternative finance, such as crowdfunding and peer-to-peer lending. There are new regulatory approaches, such as regulatory sandboxes and special licensing regimes. But fintech also introduces new risks, especially for less educated financial consumers, and that points to the need for what we call digital financial literacy, which is more knowledge about the digital products and the risks which are becoming increasingly available. Now, what happened as a result to as a response to COVID-19? This is taken from a study by the Cambridge Center for Alternative Finance, which did a pretty comprehensive survey of central banks and regulators about what they were doing. The first area was the KYC, anti-money laundering, and digital identity space. So they facilitated use of electronic KYC in some cases where it wasn't permitted. They allowed digital onboarding, although in some cases I think this was more of a temporary measure. There was economic relief, provision of emergency liquidity facilities, including for fintech firms, concessional funding for commercial banks and credit institutions, business continuity planning, increased cybersecurity, so enhancement of requirements and controls, and strengthened cybersecurity oversight and supervision. There was a more digital approach to regulation, trying to do more online. And in the digital payments and digital lending space, there was waiving or reduction of transaction fees and increase of transaction limits and thresholds. And in some cases, digital lenders were authorized to issue credit cards and fund other operations. But I think the main way you might characterize these measures is they're trying to support the financial sector in general and to ease transactions. But there wasn't necessarily, I think, a significant increase in pro-financial inclusion policies per se. So I think overall, central banks have already been active in promoting financial inclusion, often nested within national financial inclusion strategies. So innovations regarding ID, KYC, AML-CFT, innovations regarding products and access, various regulatory approaches for financial inclusion institutions, and also for fintech firms, such as regulatory sandboxes and tailored licensing regimes, financial education programs. In terms of the impacts of COVID-19, we certainly saw a greater demand for online financial services. And I think governments also see greater utility of online services for delivery of aid and other funding. But I think the central bank reactions were more directed at the financial sector as a whole, as opposed to financial inclusion specifically. And the single recommendation that I would make at this point, or perhaps the most salient one, is that there needs to be more focus on digital financial literacy. It's not really included in financial education programs that much yet, but with the increasing use of fintech and also all the risks that come with it, especially for those who are not very financially savvy, I think that there needs to be a much greater emphasis on that in the financial education programs. So let me stop there. Thanks very much.
Thank you very much, Peter. A very comprehensive presentation. You are indirectly addressing my initial question about what the central bank can do to improve financial inclusion. Of course, it's not in the area of monetary policy, but in the regulatory side. But nonetheless, yes, I think it has been very informative and interesting. Now we are going to go to actual two practitioners are the next speakers. The first one is again Abdul Bashar from Bangladesh Bank. So we are going to now to have a little idea from the trenches on this area of financial inclusion and addressing these problems, regulatory problems. So the question is as follows. In this digital age, financial cybercrime and fraud is on the rise. This tends to disproportionately hurt the poor and vulnerable population groups because they have less knowledge on how financial system and products work. What action has the Bangladesh Bank taken to enhance financial literacy and strengthen financial consumer protection? What are the outcomes of this initiative so far? Mr. Abdul Bashar, the floor is yours.
Good morning, good afternoon, and good day to all of you. I am directly going to my presentation. My presentation topic is promoting financial literacy and strengthening financial consumer protection in Bangladesh. So as time slot is very limited, and I'll try to share my country experience with few slides. Next. First of all, I want to produce here the definition of financial literacy as stated by Organization for Economic Cooperation and Development. So they are telling financial literacy is a combination of awareness, knowledge, skill, attitude, and behavior necessary to make sound financial decision and ultimately achieve individual financial well-being. So here in the picture, you see that emphasis is given on knowledge, behavior, and attitude. Financial well-being of an individual is done. So next, then why financial literacy is important? Globally, it is recognized that financial literacy and financial inclusion with a robust consumer protection framework are very important to the empowerment of individual and overall stability of the financial system. Research reveals that financial knowledge and behavior tend to be positively correlated with income and education levels. Inadequate financial literacy is one of the major obstacles or barriers in access to finance in Bangladesh. Low level of financial literacy among the rural people has been the main reason for inefficient use of the financial services. Then COVID pandemic has reissued the need for financial literacy, especially digital, because physical visit for financial service poses a high risk of contamination. Financial literacy is not merely to create awareness. Rather, it is a permanent process of ingraining knowledge on responsible financial services and businesses So when financial literacy added to individuals' skill of use and confidence and knowledge, then financial empowerment is achieved. So financial literacy and consumer and empowerment in NFISB. Would be very happy to learn that very recently our government has approved a National Financial Inclusion Strategy, and already in Central Bank, Bangladesh Bank, there is a unit called NFIS Administrative Unit has been established, and we are now we have now started working on planning how to reach the goal. There are 12 goals in our NFIS, 69 targets. Goal 4 is about financial literacy. To promote financial literacy and consumer empowerment, emphasis is given here. So targets, there are many targets, 69 targets. So financial literacy targets, I am just quoted here some points here. Formulate financial literacy policy strategy by all financial sector regulatory bodies separately. Formulate consumer protection framework and grievance redress system by all financial sector regulatory bodies separately. All regulated financial service provider will have annual program on financial literacy, which will be monitored by the respective regulatory body. Take necessary initiative with Ministry of Education to incorporate financial literacy at all levels of education, primary, secondary, and tertiary. Assess the feasibility of introducing consumer protection mechanism similar to deposit insurance scheme for banks. So consumer protection, what sort of measure Bangladesh Bank as a central bank we are taking? Already you would be happy to learn that in 2012, there is a dedicated department called Financial Integrity and Customer Service Department has been established. The objective of this department is to protect the interest of the customer related to banks and financial institutions within the legal and regulatory frameworks, to redress the grievance of the customers and to attend a complaint received against banks and financial institutions or its many officials, to improve banker-customer relationship, to ensure the standard customer service of the banks and financial institutions. We already provided guidance for customer service and complaint management for bank and financial institutions. Established a 3-tier complaint management system in banks and financial institutions. These are Central Customer Service and Complaints Management Cell, Regional Customer Service and Complaints Management Cell, and then Customer Service at branch level and Customer Complaint Cell. Then consumer protection measured by Bangladesh Bank. I am just escaping this slide. So consumer protection measure taken by Bangladesh Bank. Here you will see that we have a hotline 16236 during office hour. It remains open, and anybody, any customer, any consumer can access to this number, and our officials are dedicated to receive their complaint. There is an email bbcipc@bb. There is a fax number and also mobile apps. Any consumer, if they have given, they can reach here and lodge complaint. Complaint lodgement procedure. Okay, I am just escaping this slide because it has been narrated here. Just in the slide, you see, I have tried to bring here the data of complaint we received from April 2011 to 2021. You will see that from April 2011 to 2021, the data we received 40,638 complaints, and we resolved so far 40,614. So you may say that almost 100% complaint has been resolved. In the bar chart, also similar. From 2017 to 2021 of June, I have given the bar chart. So here also the resolution rate is 100% almost. So what sort of initiative as a central banker we are taking for financial literacy? As financial literacy is very important, we are taking different financial awareness campaign like awareness raising campaign under different refinance scheme. open credit disbursement program, arrangement of a special fair such as banking fair, SME fair for women entrepreneur fair, etc., to build awareness and financial literacy among mass people. Distribution of brochure, flyers, pamphlet, leaflets, broadcasting, television, commercial, radio, jingles, video, documentary, advertisement in newspaper. Countrywide financial literacy campaign and school banking conference targeting a student under age of 18. Instruction to banks to increase the level of financial literacy among women entrepreneurs agent and MFS agent. So financial education initiative by Bangladesh Bank. I have earlier mentioned that already our government has approved NFIS-B. So you would be happy to learn that half of the population of our people is under the age of 35. So we are enjoying here a demographic dividend. So understanding the notion, BBA has taken initiative to include the financial literacy content in the textbook of the primary and secondary level. The National Curriculum and Textbook Board of Bangladesh is currently working on finalizing the curriculum for the primary and secondary level for education year up to 2023 and onwards. BBA is working closely with the NCTB to incorporate the financial literacy chapter compatible to the textbook for primary and secondary level. So we are striving for a financial literate society. In our strategic plan of Bangladesh Bank, these three Bangladesh Bank for 2022 to 2024, the following three issues have been focused: financial literacy guideline for banks and financial institutions, development of financial literacy web portal that shall consist of interactive financial literacy material, production of financial literacy videos with a special attention towards women, students, marginalized, and low-income people. Since financial literacy can sensitize people with knowledge and behavioral sense in crafting choices between consumption and saving, the said action are believed to be effective in financial decision-making of the people. You know, we are now under horrible situation of COVID-19 pandemic. So COVID-19 pandemic has reassured the need for financial literacy, especially digital financial literacy, so as to avail financial service, avoiding the risks of contamination. Thus, maintaining a well-designed and enriched financial literacy web portal can serve a digital financial literacy tool to assist people who would prefer information and knowledge on financial services and matters. So financial literacy guidelines, it is in the process to be formalized. The key focus areas identified in the draft financial literacy guidelines are savings, borrowings, financial planning, financial product and access to financial service, entrepreneurship, financial system and participant, payment system and digital transformation, grievance redress system, and consumer protection. Target people set in the financial literary guidelines are farmers and marginalized people, students, micro merchants, retailers, women, migrant workers, youth, SMEs, wage earners, RMZ, youth, leather, weaver, etc., physically silenced people, and underprivileged, third gender, itinerant community, working teens, social safety net beneficiaries, Tier 3 TSS, cooperative society, business association, and all other vulnerable groups as identified time to time. So programs and means of financial literacy. General financial literacy program, in-person face-to-face program, thematic campaign on topics such as digital payment, e-banking, password protection, money laundering, borrowing, saving, remittance, etc. Others as a competition, stimulation game, state flag. So communication tool, as a communication tool, we are using booklet, presentation, infographics, flyers, a leaflet, brochure, banner, poster, advertisement, virtual, printed, audiovisual. I am not reading out all. Communication channel, training workshop, seminar, conference, symposium, electronic print media, roadshow, fair, social gathering, mobile apps, web portal, others, etc. Then challenges to implement financial literacy. COVID-19 pandemic, you know that there is a discovery of another Omicron. We are very horrified. So we all to fight against this COVID-19 pandemic. Lack of technological device used by the target people, lack of education, illiteracy, lack of responsiveness of the financial literacy providers such as bank and financial institutions, social and religious exclusion, lack of coordination among stakeholders, lack of infrastructure, and inclination of resource allocation of the FLFs, lack of data, lack of capacity of the resource person of the financial literacy programs. According to OECD, recommendation of way forward. According to OECD, financial inclusion, financial consumer protection, financial literacy policy need to be evolved in parallel because they are to contribute to the financial well-being of the population to inclusive growth. Public, private, and non-profit stakeholder coordinated partnership in supporting and delivering financial literacy education program to provide information about basic financial products can contribute efficiently to increase awareness of related risk and more generally inform consumers of their rights and responsibilities in financial markets. Increasing use of digital tools such as videos, apps expected to be useful for delivering financial literacy among the tech-savvy young generation as well as adults. Data collection and development of integrated financial consumer protection and education framework to support financial inclusion. Use of digital financial service to improve financial inclusion while addressing new challenges. Effective financial education delivery, including through digital tools, and evaluating the impact of the initiatives on regular basis. So these are all very simple presentation in front of you. Thank you all.
Thank you very much, Mr. Bashar. Very, very interesting and informative. Really, Bangladesh Bank is doing very good job in this. This is such an important element, right? People tend to forget about it, focus on the development of the markets, on the regulatory side. But without an informed public, there can be a lot of risks, both for the consumers in the form of fraud, but also systemic risk, in the form of, problems with financial institutions. So I think this is very commendable, and there's something that many other countries in the region also should be looking into. Now we are going to shift gears a little bit. Peter Morgan mentioned a little bit the fintech area and payments, and interestingly, this is an area that has been developed mostly by the private sector. But now central banks are trying to get into the game, so to speak, by looking into digital, central bank digital currencies. So Mr. Tamarak Monjek is the chief representative of the Bank of Thailand in the London office. I would like to ask you the following. Central bank digital currencies are increasingly viewed as an instrument that can transform financial inclusion around the world. Where does Thailand stand on introducing a central bank digital currency? What opportunities lie ahead? Despite its potential benefits, what should developing countries be mindful on when introducing central bank digital currencies? So Mr. Monjek, the floor is yours. The floor is yours. Thank you.
Thank you. Hi, good morning. It's an honor for me to be here sharing with you our experience in central bank digital currency. Next page, please. Yes. The presentation today would have 3 questions to answer implicitly. First, where does the BOT stand in introducing central bank digital currency or CBDC? The second would be on opportunities that lie ahead, and the third one would be on the potential benefits and the risk that we need to be mindful when introducing CBDC. Next page, please. So currently, central banks around the world are investigating or researching central bank digital currencies. The recent survey from the BIS showed that more than 80% of central banks in the survey are engaging in some way or another on researching central bank digital currency. For us at the Bank of Thailand, we started our journey in 2017. The initial goal was to understand how distributed ledger technology, or DLT, could be used to issue a CBDC and how this might affect the financial system. At the time, I think the buzz was that with blockchain and DLT, intermediaries would be replaced by the network. Because transactions could be made, verified and settled on the blockchain on DLT without intermediaries. So with that buzz, we thought as a central bank, then how we can use this technology to actually help improve the financial system, and how we can get the stakeholders to come together and learn about this, so that the financial system may not be too much disrupted. So in 2018, we started proof of concept on wholesale CBDC. So the thinking was that to understand the technology, we need to actually get our hands dirty. So we need to actually implement the technology, and this we cannot do alone. So we do it with stakeholders like banks and non-banks and corporates. And different departments in the bank would have to come in and work together, because with this technology, internal process might have to be changed, and also the policy might be affected, and we need to learn about the effects together with the stakeholders. So since 2018, we have conducted 4 proof of concepts, so testing in the labs. 2 POCs, 2 proof of concepts or POCs were on domestic wholesale CBDC. So wholesale CBDC is something that is used among the financial institutions that have access to the central bank account. We did this with 8 Thai commercial banks. We also did a cross-border wholesale CBDC with Hong Kong Monetary Authority. The project is called Interloan Lion Rock. And we also explored wholesale CBDC for corporates. So how CBDC could be used to help with supply chain financing. We use smart contracts to check how money could be paid to the suppliers of goods to the buyers. So I mean, once the goods are delivered, then the money could be delivered promptly. So to help SMEs, for example. Since 2020, last year, we have been following a 2-pronged approach. So we have a retail CBDC proof of concept done this year. Retail CBDC is something that general population, merchants, individuals could access. And the pilot is planned for 2022. We also pursue multi-currency CBDC or MCBDC with 4 other central banks. This is a project that we work together along with the BIS. So we have People's Bank of China, we have Hong Kong Monetary Authority, and Central Bank of the UAE. Next page, please. So since the focus of our next phase would be on retail CBDC, and this actually might touch the citizens more broadly, at least in the context of Thailand. So we focus more on retail CBDC. So our goal this time is to investigate how retail CBDC might actually be a new and complementary infrastructure that help future-proof our financial system. Currently in Thailand, people can transfer money via mobile phone quite easily. And the growth of our faster pay retail payment, which is called prompt pay in Thailand, the growth of usage has been almost double during the pandemic. So we have about 55 million people registered with prompt pay. So a lot of people keep asking, why would we be introducing CBDC, or why should we think about retail CBDC when the existing system is quite efficient? But when we look deeply into the technology, it seems that retail CBDC would offer something that existing system might not be able to. for example, more innovations through programmability, smart contracts, for example. And as such, we are designing retail CBDCs such that it would be more inclusive. So if you look on the right, on the diagram, on the picture on the right, we could see that we have a system. The current system is that we have the central bank, we have the bank level, which is probably also include non-banks as well. We can think of that. And in the circle below, we have deposit and e-money. This is our current e-payment system. The other branch on the leftmost is the banknotes, and this is where the central bank actually interact, although indirectly, with the citizens, with the individuals. But the banknotes are actually claims on the central bank. The key question now is how to create digital banknotes to help complement the existing system. So one thing to be noted is that although our existing payment system, like PromptPay, is very efficient and is quite has quite a wide coverage, not everybody in Thailand has a bank account. Our survey on financial access of households in Thailand suggests that quite a number of people, almost 20%, actually choose not to have a bank account on their own. So it's like self selection. And even with e-money, a lot of people use e-money in Thailand, but it is a closed system, so you cannot use it to purchase goods everywhere. It's just only those merchants that accept e-money that you can use e-money there. So going forward, a cashless society could come faster than what we thought. So in China and Sweden, as probably all of us are quite aware, restaurants and taxis do not accept cash. And people there are complaining that they don't have access to banks, to what we call central bank money. So how do we create central bank money that would be that could be interfaced with digital channels? That's one thing. Next page, please. So for our design for retail CBDC, this is initial design. So we look at retail CBDC as digital banknotes. So individuals do not have to hold accounts at the BOT. It's like banknotes. We don't have accounts at the central bank. And it would be a two-tier architecture. So we would have the central bank as the first tier, and then we have bank and non-banks who would act as custodians or distributors of CBDCs. And for this, we do not want CBDC to compete with commercial banks' deposits or e-money accounts. So CBDC will not pay interest. We also limit the wallet size according to user characteristics. So individuals might have lower, for example, lower wallet size compared to merchants. The wallet size might be also distinguished by KYC level, for example. And the key to this is that it would be open to innovations by both banks and non-banks who can come in and develop applications on top of CBDC infrastructure. It would be more inclusive in the sense that we allow more people to participate as financial service providers. So it's like we have CBDC as infrastructure, and then the private sector, banks and non-banks, can come in and create innovations that allow them to address the pain points of the users. Our pilot next year would be kept to a well-defined but inclusive group of users. We need to limit our group of users at this moment by the number, because we want to contain risk. But the users would come from every walk of life, and the merchants in the test would be quite varied. Next page, please. We would have two tracks on the test. One would be foundation, how we can actually make payments, basic payment with CBDC, and innovation track where we allow we invite private sector to come in and provide innovations based on the infrastructure that we build. Next page, please. Yep. So things to be mindful. First is technology. Cyber security would be even more so important if we actually introduce CBDC. Capacity building would be essential for all the stakeholders, not only within the central banks, but financial service providers, as well as users. Digital literacy would be very important. On policy side, we have to look carefully about the effect it might have on financial stability. Would we be disrupting the banks, the non-banks? They have to redesign their business model. So we have to be careful. And we have to be careful about monetary policy transmission, cross-border implications, and AML and CFT as well. Personal data would be very important to ensure the trust in the system. And on the last thing, but very important thing, is that the adoption would depend on whether retail CBDC could solve the pain points of the users. Next page, please. So conclusion, our CBDC journey is an iterative one. We have been doing a few POCs, and each would look like a piece of jigsaw. We need to complete the jigsaw later. And this is quite difficult. I mean, it's quite challenging anyway. And stakeholders' engagement are critical because the central bank cannot do it alone. We need everyone to come along. And this is just the beginning of the journey. Yeah, so technology, policy, legal, business issues remain and are evolving. And we need to integrate wholesale, retail, and cross-border CBDC for further exploration. So thank you very much. And in the slide, there would be links to reports that you, in case anyone is interested. Thank you.
Thank you very much, Kun Amarak. This is very, very interesting. I really appreciate your presentation. I was very interested always in this topic, but I think this is a very clear presentation. I'm very interested in reading the additional material that you have. We are now going to switch gears a little more for the last presentation of this initial segment. We have Professor Ulrich Bolz from the University of London. The question is the following. Fiscal policy, such as carbon taxes, has been the center of attention in promoting green development. Yet, green central banking is gaining some momentum, including here in Asia and the Pacific. What are the driving forces behind this trend? How do climate-related issues affect the conduct of monetary policy and its effectiveness? For central banks that seek to promote low-carbon, climate-resilient development, what are the available monetary policy tools? The floor is yours, Ulrich.
Thank you very much, Alberto. Let me just try to get my slides up and running. So I trust you can see the slides properly now, right?
Yes, we can.
Okay, great. Well, so first of all, thanks a lot to ESCAP for inviting me to this really interesting and very timely forum. And I'll try in my presentation to answer your question, Alberto. And I've been working on this topic now for more than a decade. And when you would talk to central bankers, to supervisors, back then, there was very little interest to engage on issues of, climate change, environmental sustainability more broadly. And this has changed completely, and I will try to lay out why this has been the case and why it's absolutely crucial that central banks and also supervisory authorities look at climate and environmental challenges and indeed sustainability challenges more broadly. And you rightly pointed out that much of the discussion around climate policies has been centered around carbon pricing, and without question, we do need carbon pricing, but this is not a single fix. And the reason, or one of the main reasons why we need central banks and supervisors to engage with this topic is that if we want to be successful in a low carbon transition, we need the financial system to align with sustainability and climate goals without redirecting finance from investments in dirty activities to investments in green sustainable activities. We will not be able in achieving the climate and indeed other sustainability goals. So let me first address the question, why should central banks and financial supervisors care about sustainability? And then in the second part of my presentation, I will say what they could and indeed should be doing. So first, why should they care? And we have now seen a consensus really building in the central banking circles. And like in the case of Peter, when I talk about central banks, I also talk about supervisors, because much of that is relating to that space as well. You know, it's widely acknowledged now that environmental problems, and the focus has been very much on climate change, but also issues such as biodiversity loss, soil, water, air pollution, and so on, are undermining our very existence. So they are threatening human well-being, and they are threatening economic activity. And by implication, they're also threatening macro financial stability. And that's, of course, where central banks and also supervisors have a keen interest in, because their main mandate is to safeguard macro financial stability. So there is an awareness that they have to play a role in mitigating macro financial stability. And there's also, as we heard from Peter in his presentation, there's now a growing recognition also that central banks need to care about the socio-economic impacts. Many central banks actually have secondary mandates on employment, but also there has been a lot of interesting research showing that inequality hampers growth and can also cause financial instability. And it can also make monetary policy less effective. So central banks clearly need to look at climate risks, other sustainability risks, including also equity concerns. But let me first say a little bit more about the climate risks. So as was mentioned in the intro, there are two major climate risks. So there are the transition, well, they're the physical risks, so from the physical impacts of climate change, chronic impacts, so kind of gradual temperature rises, sea level rise, and so on, but also climatic events, storms, heat waves, and so on, wildfires. And all of these very obviously have a very direct impact on economic activities, both at the micro level, but also at the macro level. And then we also have the transition risks associated with climate change. These stem from policy responses, so new policies and regulations, such as carbon pricing, for example, but also technological change. If you look at the energy sector, there is dramatic and very rapid technological change, also automotive sector and so on. And also consumer preference is changing. Consumers care more about climate issues, sustainability issues. And all this is having very direct impact on our economy. And the implication, as I said before, is that this can translate into financial risk. And there are different types of financial risk: credit risk, market risk, underwriting risk, operational risk, liquidity risk, and so on. And then, of course, there are a lot of feedback loops. If the financial sector is impacted, and this will affect its lending investment behavior and then have repercussions on the real economy. So there are many ways how climate change can affect financial risk, and it is now widely recognized in central banking circles and supervisory circles that climate change not only has material financial risk, but that it can also be a systemic risk. The BIS has published a much noted study where they spoke about green swan risk, and they argued that climate change could indeed trigger a new systemic financial crisis. Very importantly, of course, for central banks is also the impact of climate change on macroeconomic variables. And all kinds of macroeconomic variables are already impacted and will be even more impacted in the future. And monetary policy will have to consider these impacts. So it will have to distinguish what are temporary effects, what are permanent effects, how is the monetary policy transmission channel impacted, and so on. So monetary policy is becoming much, much more difficult in a world undergoing climate, in a world of climate crisis. And there is indeed empirical evidence that the physical impacts of climate change are already affecting price stability. And that's not only an issue for developing emerging economies. We actually conducted research this year where we showed that even in the Eurozone, we already have significant impacts of climate-related events on price stability. And of course, these are going to get worse. So monetary policy really needs to consider how it will be impacted. But there is another very important issue, and that is, again, we have been able to empirically show that climate change is already driving up the cost of capital in climate vulnerable countries. And that is true both for sovereigns, so governments have to pay higher cost on their capital, but it's also true for corporates. And so it's actually also worsening access to finance problems that were discussed before. And this, of course, is also undermining the ability of both governments and corporates to adapt to climate change, to invest in resilience, and of course, invest in all other areas they should be investing in. So there clearly are manifold implications on the economy, on the financial system, on the macroeconomy, and central banks need to address those. So what should central banks do? Well, this obviously will depend on a specific context, but there is a broader framework emerging now, and this is actually all pretty much common sense now. So this is not very controversial what I'm presenting here. When it comes to the translation into details, it's of course becoming much more complicated. But so one thing is clearly we need better data. So central banks, supervisors need to help increase transparency, increase information on climate-related financial risks. And central banks and supervisors have been starting to work on that, trying to establish standards, also taxonomies. So for example, if we want to increase investment in green sustainable finance, we need to define what actually is green and sustainable. But by the way, it's also very important to define what is dirty investment that we need to cut. So that also is an important part. So kind of enhancing market practice, transparency, disclosure, and so on, that's a very important part of the agenda, but that alone will not do. It will be absolutely critical, and this is now really starting to happen, to integrate climate-related and also other environmental risks into financial stability monitoring and in both micro and macroprudential supervision. And actually the Basel Committee on Banking Supervision just now has published a paper and has a public consultation. And so there are discussions about adjusting the Basel framework and so on. And these are absolutely critical because the micro and macro financial risks may be substantial. Very important is that an increasing number of central banks is now looking at scenario analysis and stress testing. So climate change and climate-related financial risks are very different from traditional financial risks. Past models, past experience won't tell us much about climate change because climate change is non-linear. We are going to have tipping points. Of course, there's a lot of uncertainty regarding the policy actions that we're going to see, and then also the emission pathways that we're going to see. So climate scenario analysis and stress testing is an important tool. And this year alone, we have 19 central banks that are working on climate stress test. And then, of course, central banks also need to adjust monetary operations to account for sustainability impacts. And this relates also to what are the impacts of their own monetary operations on the environment, on the climate, and also on social issues. I'd love to go more into that, but I won't have time to do so. And then also one issue that is now widely recognized is that central banks actually manage a large portfolios. Their own portfolios, also often pension portfolios, government, and so on. And they need to integrate sustainability factors into managing these portfolios. So that's adopting responsible and sustainable investment principles, and so on. And central banks actually do have a lot of tools they could use, and they are increasingly looking at what they could use, what they should use. So there are monetary instruments, for example, adjusting collateral frameworks, reserve requirements that can take into account climate risk. Yeah? There has been a lot of discussion about asset purchase programs. So some have argued for green QE. I've always argued that green QE is a daft idea. But what central banks should do is when they conduct QE, they should certainly look at what assets do they purchase, and then also account for climate risk, and they should exclude certain dirty assets, because for now the QE programs around the world have all had a very high carbon bias, and that is not good. Some central banks, especially also in developing Asia, have used more direct monetary policy instruments, so kind of credit allocation. Bangladesh Bank has been spearheading that, Reserve Bank of India as well. So prudential policy, there are tons of macroprudential and microprudential instruments that can be used to address systemic climate and other environmental risks, and then of course also other things like portfolio management and so on. And more broadly, it is crucial that central banks, as the guardians of the financial system, really set out clear strategies of how they want to address these climate-related risks, but also how they will support the alignment of the financial systems they are overseeing with sustainability. And there are two very strong arguments why they need to do that. The first is macro-financial stability. So very clearly, we need to make progress on the climate side, because if not, macro-financial instability will be so great that kind of achieving price stability and all that will be exceedingly difficult. So central banks need to support kind of the alignment of the financial system with the climate goals, and this is absolutely within their mandate. And the second reason is policy coherence. We now have a large number of countries that have set out climate goals, net zero targets by middle of the century, some a bit later, and we need to make sure that public institutions like central banks and supervisors do not, with their policies, undermine, contravene these public goals. So central bank supervisors need to set out a clear vision of how they want to support the financial system in aligning with sustainability, and that will be crucial for economies to properly prepare. And in the context of this conference, I also want to highlight that central banks and the financial system more broadly can also play an important role in supporting the just transition by promoting inclusive green finance. So trying to achieve a transition to a low carbon economy will not work if we don't make sure that it's also a fair and inclusive transition. And we will see structural changes in this transition. Some sectors will decline, some jobs will be lost, and governments need to make sure that this process will be fair and socially acceptable. And for this, we need the financial system, because we need the financial system to help investment in new activities that are fit for the future. And so we need the financial system to support these new investments. But also, very importantly, climate change is deeply unjust, both internationally and within countries. So the countries that have contributed the least to climate change, so the developing countries, they are feeling the biggest impact of physical climate change. And so that they are hit the most. But also within countries, those at the base of the economic pyramid are being hit the most by climate change. And they are the least able to adapt to climate change. And so, again, finance will not be the only fix, but financial services can help people at the base of the economic pyramid, also small, medium enterprises, to invest in resilience, to better adapt to climate change and also other environmental change. And we have put forward with the Alliance for Financial Inclusion this concept of inclusive green finance, which is linking this kind of green finance with the sustainable finance agenda. So we need to take a really holistic perspective. And there are, for example, lots of interesting fintech solutions that can really help to combine kind of the financial inclusion goals with goals of helping small, medium enterprises and also poorer households to invest in adaptation and resilience. Now, I'm coming to a close, don't worry, but I do want to highlight that, I've been talking about central banks, that they need to play a crucial role. But that, of course, does not diminish the role that governments must play in addressing climate change. So I'm not saying that central banks should be, the heroes now to save the world by themselves. So central banks by themselves can't solve our problem here. But it's important to realize that without the necessary changes in the financial system, and for this we do need central banks and supervisors, we won't be able to achieve kind of the sustainability goals either. So central bank supervisors have to play an important role by complementing, catalyzing, and amplifying government's climate policies. They're not asked to substitute them, but they are really an important part. So with this, let me finish, and thank you very much for having me, and thanks a lot for your interest.
Thank you very much, Ulrich. Fascinating presentation. I have to say I learned a lot from it. In my previous experience, there was a lot of discussion about the role of central banks and the regulatory side, right, to mandatory, climate disclosures and things like that. But you're really providing a much broader picture, looking at the monetary policy aspects as well. And I think it's very, very interesting. I'm sure that people are very keen on asking questions. Unfortunately, we are kind of running out of time. So I would like to go on immediately to the second segment of this program. But I don't want to discourage anyone who has questions. Please keep them for the end. We have a little time. Otherwise, send your question, put your questions in the chat. One way or another, we'll make sure that the questions go to the presenters, and we'll get back to you. So let me now move to the second segment. This is going to be very complementary to what we have discussed so far. It's going to be on the financial side. We have 3 speakers for this segment. I will be very grateful if you can try to limit your presentation to about 12 minutes, a little around that time, so we have a little time at the end if there are questions. The speakers are the following. We start first with Ms. Darian McBain from the Monetary Authority of Singapore. We are going to move next. We are going to have a little change in the order, because the last speaker needs to leave earlier. Mr. Michiru Toda from Japan's Social Innovation and Investment Foundation will be the second speaker. And then we will have Ms. Louise Gan from HSBC. So let's start immediately with Ms. Darian McBain. The question is as follows. The number of companies raising capital via sustainability-linked debts has grown dramatically in a, sorry, I apologize. I have an initial introduction to the topic by my colleague Lin Shuo. Lin, please go ahead. I'm sorry I forgot about you. You go first.
Can you all see my screen now?
Yes, we can see.
Okay. So in minds of time, I will be very quick. Here, so today, we just heard about how central bank can play a role in foster the inclusive development. In the next 1 hour, we will focus on the role of financial tools to support inclusive recovery and development. We highlighted 2 financing tools in our survey, sustainability linked bond and loan, and social and development impact bond, which is also called pay for success in some countries. And we will first hear from MAS, from Darian, to provide us an overview of MAS financial policy for inclusive development and share their experience in supporting the development of sustainable finance as a regulator and shed light on their future plans. After that, we will first highlight that the first financing tool that we highlight in the survey will be social and development impact bond. Again, I would not go into the detail because we will have Michiru from Japan Social Innovation and Investment Foundation to go through the detailed structures of these nuanced financial tools with us. Briefly speaking, it is a form of outcome-based contract. Investor will cover the upfront capital required for a service provider to set up and deliver a service, and the service should achieve predefined outcomes specified by the outcome funder. Investor will be repaid by the outcome funder only if the outcomes are achieved. As such, it can potentially increase the effectiveness of the government spending. Therefore, on one hand, it can be a complementary tool and play a role in attracting private capital to solve some of the social development needs. And on the other hand, it can be a powerful tool to make the delivery of public service more efficient. However, it's currently underused in the Asia-Pacific region, and Japan is one of the countries in the region leading in this field. That's why we would have Michiru from Japan to introduce this model with us. And the second tool that we highlight is sustainability linked debt. It represents an exciting and relatively new category of financial instrument that can be leveraged to incentivize social development. So broadly speaking, sustainable linked debt are defined as a debt instrument that have interest margin linked to the sustainability performance rating or target. And we will have Lu Ying from HSBC to introduce this nuanced instrument and share with us some of the latest transactions in the market from the investment bank's perspective. So with that said, I will hand over to Alberto. Thank you.
Thank you very much, Lynn. Again, apologies for forgetting about your introduction. Okay, we are now going to the first speaker of this second segment is Ms. Darian McBain from the Monetary Authority of Singapore. The number of companies raising capital via sustainability-linked debts has grown dramatically in a relatively short period, notably since the launch of the sustainability-linked loan principles in 2019. From Asia, Singapore clearly stands out with the highest recorded number of sustainability-linked loans. On 24 November 2020, the MAS launched the world's first green and sustainability-linked loan grant scheme, which was effective from 1st January 2021. At the same time, MAS expanded the scope of existing sustainable bond grant schemes to include sustainability-linked bonds. How do the 2 grant schemes contribute to the faster growth of sustainable debt finance in Singapore, particularly sustainability-linked loans and sustainability-linked bonds? What lessons has the MAS learned from managing these two schemes? How does the MAS compare sustainability-linked loans and sustainability-linked bonds with other types of sustainable debts? The rise of sustainability-linked bonds has so far been mostly used for green development. How likely do you see it wider use for social development? What additional support has MAS provided or plan to offer for the development of sustainable finance in the future? The floor is yours, Miriam.
Thank you very much, Alberto, and hello, everyone. It's an honor to be here. Thank you very much for inviting me to speak today. So this follows very well from Ulrich's presentation that we just had, giving a very practical and tangible example of the role of a central bank, particularly in growing sustainable finance in Asia. You know, I was listening to the speech by the UN Secretary General recently on tackling the inequality pandemic, and he referred to two seismic shifts that will shape the 21st century. And that was the climate crisis and digital transformation. And done well, these shifts can be inclusive and deliver real positive impact to people in the global north and the global south. But if devised without inclusivity in mind, of course, then you could actually increase and further exacerbate inequalities. So these are two areas that MAS is really working on, and I wanted to share some practical examples of what we're doing today. I mean, some examples of financial inclusion that we're working on, two that I'll mention: UNDP, Global Center for Technology, Innovation and Sustainable Development. We're working with them to help small and medium-sized enterprises leverage technology to better access global value chains. And we're the first central bank to join Merger Loop Foundation to provide the underserved access to affordable financial services through digital currency-based settlement systems and foundational digital infrastructure. So those are just two examples, but today I'm mainly going to focus on the climate crisis and financing to support Asia's transition to a low carbon economy. So this includes investments in green infrastructure, renewable energy, energy efficiency, climate mitigation and adaptation activities. We see managing climate risks as absolutely critical, as the impact of more frequent and severe weather events can be a major setback to economic growth and development. So I'll start by giving an overview of MAS's Green Finance Action Plan and then going into more detail. If I could have the next slide, please. So the Green Finance Action Plan was developed in 2019, and as you can see, has these 5 pillars. So the first one is strengthening the financial sector resilience to environmental risks. Next, developing green and financial solutions and markets for a sustainable economy. Building knowledge and capabilities in sustainable finance. Harnessing technology and enhancing climate-related disclosures and data. And all of these activities are going on in collaboration with international and regional efforts. So if we go to the next slide, please. So some examples of progress that have been made. A good one is under the first pillar, the Guidelines on Environmental Risk Management, which set out MAS's supervisory expectations for banks, asset managers and insurers in the key areas of governance, risk management and disclosure on environmental risk. Going to the next pillar, grant schemes for bonds and loans, which I'll cover in much more detail, as well as the launch of Climate Impact X, which is an Asia-based global marketplace for high-quality carbon credits. Onto the third pillar, anchoring green finance centres of excellence, think tanks and research networks, which will contribute to rigorous Asia-focused green finance research. Looking at technology, MAS has also embarked on what we call Project Greenprint, which involves partnering with financial institutions, fintech firms, and industry players to drive fintech solutions to mobilise capital, monitor commitment, and measure impact. And lastly, the Green Finance Industry Task Force is convened by MAS and is developing a taxonomy for Singapore-based financial institutions, which includes transition activities with consideration of the key economic sectors and the mission-intensive sectors in the ASEAN region. If we go to the next slide, please. So while the global sustainable finance bond and loan issuances continue to reach new highs, Asia-Pacific currently accounts for only about 1/10 of the sustainable lending market. So sustainable financing needs to grow to meet the region's financing needs. Singapore plays a very active role in this respect. So it serves as ASEAN's largest green finance market, constituting over 44% of the green, social, sustainability and sustainability-linked bond and loan issuances between 2016 to 2020. And between the 2017-18 year to 2019-20, our green finance markets increased nearly fivefold. So in 2020 and 2021, despite the pandemic, Singapore continued to observe good growth momentum in green financing volumes. We've also seen companies, including traditional carbon-intensive industries such as maritime and agri-food sectors, take up sustainable financing. Some good examples of this would include the agri-food company Japfa's listing of a US $350 million sustainability-linked bond on the Singapore Exchange, and shipping company Hafnia's US $374 million sustainability-linked loan. We go to the next slide, please. So sustainable lending instruments are evolving, but they're underpinned by green or sustainable principles and standards. So the very first green bonds were issued in 2007 by the European Investment Bank and in 2008 by the World Bank. And the market has grown exponentially since that issuance, including the first corporate green bond in 2013. So the cumulative issuances hit US $100 billion in 2015, and just 5 years later hit $1 trillion. During this period, we've also seen a growth in other green debt instruments, including green loans and green sukuk, as well as the issuance of social and sustainability bonds and loans. Global social bond issuance has reached a new record of $149.4 billion in 2020, an eightfold increase from 2019. In Asia, social bond issuances comprise around 23% of the global total in 2020, compared to around 12% in 2017. So it's clearly growing. Proceeds from these instruments are earmarked to finance eligible green and social projects or activities. Sustainability-linked bonds emerged as a new product in 2019 with the issuance of a $1.5 billion 5-year bond by Enel, an Italian energy company. So sustainability-linked debt has the advantage of being accessible to a wider range of companies for general corporate purposes and not just to finance green or sustainable assets or projects. Borrowers are incentivized to achieve predefined sustainability performance targets, for example, lowering financial costs. So examples of some of these targets include improvement in carbon emissions intensity, energy efficiency rating of buildings, or improvements in animal welfare, for example. As the funds are not ring-fenced, external reviews and independent second-party opinions from independent experts are absolutely critical in ensuring ambitious, relevant, and material sustainability performance targets are set and met. Internationally accepted principles to provide the assurance on the integrity of green and sustainable financing instruments have also been developed over the years. They're also regularly updated in tandem with the exponential growth of the sustainability debt market. These reflect the evolution of best practices in enhancing transparency and integrity of the bonds and loans. So the International Capital Markets Association estimates that its green and social bond principles were referenced by 97% of the sustainable bonds issued globally in 2020. The principles were updated this year to include the recommendation to appoint external review providers to ensure that alignment with the principles exists. This is really important for the credibility given the increased scrutiny of greenwashing, and I think we've certainly heard that coming out of COP26. We move to the next slide, please. So to support businesses to access green and sustainable financing instruments, MAS has placed grant schemes that defray the cost of external reviews for such financing. The MAS Sustainable Bond Grant Scheme, in place since 2017, defrays 100% of the expenses incurred by an issuer to obtain an external review and reporting on the impact of green, social, and sustainability or sustainability-linked bonds. The scheme is available to all corporates and financial institutions beyond those based in Singapore, so long as they look to engage banks and service providers based in Singapore for their origination and verification of green or sustainable credentials. So as a consequence, Singapore has a growing ecosystem of providers of green finance external reviews. that borrowers and banks can tap on to benefit from this scheme. And these players are really important to ascertain the integrity and the quality of sustainable finance instruments and transactions. There's also a strong interest amongst issuers to issue bonds in recent years. So from 2017 to 2020, in Singapore dollars, over $11 billion worth of green, social and sustainability bonds have been issued in Singapore. These have supported a range of outcomes in the region, including sustainable infrastructure as well as social causes. So if we move on to the next slide, please. With loans being one of the main staples of funding in Asia, banks also have a really key role to play in the low carbon transition. So MAS launched a green and sustainability linked loan grant scheme in November last year. This scheme defrays the expenses of engaging independent service providers to validate the green and sustainability credentials of the loans and framework. This levels the cost consideration of taking a green or sustainability linked loan compared to other conventional loans. Similar to the Sustainable Bond Grant Scheme, this scheme is available to all corporates beyond those based in Singapore if they engage in banks and service providers based in Singapore. So the two schemes, by ensuring that the companies working with smaller financing can also tap into the needs of green and sustainability financing in a simple and cost-effective way. So you can see the two tracks here. I mean, track A defrays the cost of corporates looking to obtain a green or sustainability linked loan of at least $20 million. And track B encourages banks to develop green and sustainability linked loan frameworks to facilitate lending to SMEs and individuals requiring smaller loans. So if we move to the next slide. So these kind of frameworks feature standardized criteria and processes which can streamline the assessments of green and sustainable lending to corporates and SMEs. It reduces the friction to financing for corporates as they need not develop, verify and maintain their own framework. As you can see from the examples here on the slide, BNP Paribas, OCBC Bank and UOB have introduced sustainability-linked loan frameworks under this scheme. More from other banks and catering to various sectors are in the pipeline. And as you can see on the slide, these themes cover a broad range of themes and seek to support corporates across various sectors and activities in having efficient, clear access to green finance to embark on sustainable projects and improvements. We've seen really good traction and interest for the grant scheme. For example, OCBC has reported significant take-up of green loans in the past year, with around 200 SME clients in Singapore, Malaysia, Indonesia, and Hong Kong expected to have received financing for sustainable projects by the end of this year. We move on to the next slide, please. So this is my final slide, and it's really just a summary to look at why we need to continue to grow and mainstream green finance if we want to meet our climate targets and the Sustainable Development Goals. Firstly, the financing needs are immense, especially in the ASEAN region, which will require approximately US $200 billion in annual green investment through to 2030 to transition to a low carbon future. Credibility is absolutely vital if we're to grow sustainable financing flows in the long term, as ESG claims attract a greater scrutiny. Hence the need to mitigate greenwashing through external reviews and an emphasis on adhering to internationally recognized principles. As this is a fast-growing space with relatively new products being developed, we need regular reviews of our schemes to make sure that they are meeting the industry's needs. And for example, we included sustainability-linked products, first issued in 2019 in our grant schemes in 2020. Finally, the grant schemes are but one piece in the broader green finance ecosystem in Singapore and supporting Asia's transition. The grants by themselves would not move the needle without a strong network of service providers conducting assessments and advisory work and the development of knowledge and capabilities needed to integrate sustainability considerations into corporate decisions. So I'll end my presentation here and happy to take questions afterwards. Thank you very much.
Thank you very much. This is a very, very interesting presentation, Darian. I think that we are in a very interesting situation at the moment because there are enormous needs, to invest in sustainable development, in climate action, as you said, $200 billion only per year, only in ASEAN. So this is huge. But at the same time, there is enormous interest by investors. So it's really a good thing. Investors are, getting more into this market. The needs are very high, but we are gradually getting, scaling up, the investments to these needs. So the really important thing is to have the institutions, to regulate these new markets, right? And the MAS is really doing a pioneering work, I think, within Asia. Because without this institution, the markets are not going to function well. There will be greenwashing, investors will be reluctant to invest. So really having all these infrastructure of verifications of, is extremely important. And I think this is the direction we have to go. And incidentally, this is another important function of central banks. We have been talking about the role of central banks in financial inclusion, in monetary policy for climate change. Now we are touching upon the role of central banks in regulating these emerging markets for sustainability products. So thank you very much. I think a very, very interesting presentation. We are now moving to the next one. As I said, we have a change in the order of speakers. We are going to have Michiru Toda from Japan Social Innovation and Investment Foundation. And the question is the following: social bonds are social impact bonds are one of 5 strategies, themes that your foundation focuses on. Can you elaborate more on how these bonds can promote social development with a few case studies? And what lessons has your foundation learned from implementing various type of SIBs, or these type of bonds in Japan? And what do you think are the challenges for promoting social impact bonds in developing countries? The floor is yours, Mr. Toda.
Thank you, Albert. Can you see my slides and can you hear my voice?
Yes, we can see you and we can hear you.
So, thank you for inviting Albert, and thank you for Ruin also to change your tone of presentation. I'm going to present about the social impact bonds as Lin introduced, which is also called Pay for Success, PFS in Japan. And my session title is Financing for Impact, Solidarity, and Changes with Public Sector. So first of all, I'd like you to keep this question in your mind during my presentation. What policy implication can be drawn from the use of PFS or social impact bonds beyond the financing tool? Because I believe that the social impact bonds I'm going to present has a potential, goes beyond just a financing tool or just an economic policy. And at the face of urgency and the SDGs and COP26 agreement, we have to find an innovative way to connect social outcomes and financial policy. And I believe SIB is one of the best tools to align social outcome with financial policies. So this is just the introduction of my foundation. SIF is a nonprofit foundation in Japan to build an ecosystem.
Colleagues, please unmute, colleagues. Except the speaker. Please unmute.
Okay, so our foundation has a strategic focus in PFS and SIB, and I'm in the role of SIB PFS project lead. This is an overview of my content. I start from what it is. I will explain about PFS and SIB and why is it needed in the context of the necessity and how is it promoted. I will also cover the limitation and the challenges for further implementation. And then caveat, as Alberto might get confused, social impact bonds is different from the corporate bonds. It's not the corporate debt. Bonds just means a promise or partnership in the context of social impact bonds. And then I refer to this new scheme as mainly PFS or SIB throughout my presentation, but they are basically the same. And also there are different types and terms used to describe this new scheme. For instance, social impact bond in the UK and social impact partnership in the Australia, Pay for Success in the United States and Japan, social benefit bonds, different names in different contexts, but they're basically referring to the same scheme. So I start from what it is. So this is a widely accepted definition by the Government Outcomes Lab in the UK, which is installed in the Oxford University. Social impact bonds are outcome-based contracts, and that outcome-based contract, the investor is repaid only if these outcomes are achieved. And this is a rephrased definition by myself, and then I'm going to explain key partners in social impact bonds. And then, as you see in this slide, there are 4 players: beneficiary, outcome payers, investors, and service providers. And the SIB is outcome-based contract and partnerships in which government, which is also called outcome payers, service providers, and investors are tied to each other through the achievement of outcomes, social outcome, environment outcome, while using private funds to cover upfront funding and risk capital. And then each player has a role. So, and then as I explained, SIB can be explained in different ways. So Lynn might share a different explanation, but this is my way of explaining it. So investors or outcome payer can be taken initiative, but in Japan, usually outcome payer, the local governments take an initiative to structure SIB. And then the role of governments is first they identify beneficiaries and their unmet needs, and which are redefined as a payable outcomes. And they, in the end, they pay for achieved outcome. In the context of international development, they can be sometimes multilateral agency and philanthropic entities. So it is not necessarily limited to the local governments or central governments. And investors, they provide upfront funding and risk capital with a service provider, I mean the SIB project. And their return is based fully or partly depending on the outcomes are achieved. And they are often institutional investors, banks, corporates, or other private investors, and service provider. And they are responsible for delivering the services to the beneficiaries. And they collaborate with government and investor in the scope of outcome-based contract and partnership to deliver the outcome to the beneficiary, who are people in need in terms of various social issues. The first SIB is structured for the crime prevention in the UK. So it can be used for criminal justice, and it can be used for poverty, employment, homelessness, health, and education. And this is an overview of SIB promotion in Japan. And in Japan, overall 33 PFS projects were launched since the first in 2017. And also the policy momentum is growing as the Office of PFS Promotion was established under the Cabinet Office. And this is just a side information. My organization jointly organized the SIB session with the Ministry of Justice, inviting SIB experts from Singapore and the United Kingdom. And this is the issue areas. Left side, there's a global, and the right side, Japan's. In global, PFS is used for the workforce and development and housing homelessness. And while in Japan, which is used for the health and care, this is because Japan has a history of national health insurance system and evidence-based medicine. So the health and care areas has abundant evidence in that areas, and also strong social security system and the lower unemployment rate allows us to focus on health and care area at the time of aging society. And I will introduce a case study in the context of supporting community businesses, which is an actual case in Japanese local municipality in Higashi-Omi City, which is in the Shiga Prefecture next to Kyoto. And then it is that municipality used PFS to reform their subsidy system to support community business. This is an overview of this case study. So Higashi-Omi City as outcome payers, and the investors are individuals, the individual citizens in Higashi-Omi City, and the corporates. And the service provider, local community entities, and the beneficiaries, community business owners. So the city feels the necessity to update the subsidy system to support local community business to evaluate its effectiveness and meet its objective. And also Higashi-Omi City, like other Japanese countryside municipalities, they are feeling with the diminishing populations and the decreasing local economy. So they feel the necessity to empower community business for sustainable local economy. And they structure PFS under the subsidy scheme, as I explained in the program. And the impact, they created early stage success of community business and employment opportunity in local economy, also solidarity and collaboration between the players in the PFS. And this is a showcase of the local community business, which are supported in that PFS, community cafe, generated employment, and production sales of wooden toys generated partnerships among the local community businesses. And why is it needed? So this is a comparison between the traditional contract and outcome-based contract. In the traditional ones, the government or the outcome payer usually, the government, the commissioners usually make a contract on activity or output base. But in the PFS, the contract is based on outcome, not the activity or output. So just this differences generate the three different elements in comparison with traditional one: outcome-oriented, use of private funds, and collaboration. So this is just a reminder of my key question during my presentation. And I can introduce the benefits from the PFS core elements, which is different from traditional ones: outcome-oriented, use of private funds, and collaborations. Outcome-oriented generates the tangible outcome and accountability, and it also allows the greater flexibility and innovation in service delivery, which is different from the activity or output-oriented contract. And also, as long as we focus on medium or longer-term outcome, we can get long-termism and mitigation of future fiscal risk in the governments. And the use of private funds promotes the new and innovative service providers entry, and also investor helps monitoring during the project. And collaboration brings solidarity. And in the right side of this table, I show the examples of these benefits, but I do not go into detail in this session. And also the policy implication to changes with public sector. I believe that the SIB it can be a paradigm shift of the public sector. It might be a bit exaggerations, but the focus and definition of success can be changed from the activity and output basis to the outcome and impact basis. So there's a many shifts from traditional contract to outcome-based contract in terms of the qualification of service providers, evidence-oriented, flexibility and learning, and communication and engagement among players and time frame from short-termism to the long-termism. And how is it promoted? So PFS or SIB might be attractive to you, but the investment in SIB project are a bit stagnated in recent years. The reason why is there are potential limitation in these schemes. So again, the government outcome labs from the Oxford University identified the following limitation about impact bonds. That is not suitable for many cases, and it's expensive to develop because of the complexity and demand a high level of commitment and capacity. And sometimes it's difficult to define outcome rather than activity or output. And it might be do not foster innovation because investor might might prefer to commit to their investment in proven models. And there's also criticism about the financialization of the public sector or international aid. And this is a document issued by the Global Steering Group for Impact Investing, tying funding to the result. This ties is a motif of the SIB, which is players are tied to each other over the achievement of outcomes. And I took part in as an advisor to make this document. And this document identified the challenges for further promotion and adoption of SIB. And then lack of willingness of funders to commission on result basis and institutional inertia and misaligned systems and funding organization, and issue inherent to the RBF mechanism. So as I explained, SIB is kind of the changes or shift for the public sector. So sometimes they are not much motivated to adopt these schemes. So which is sometimes appear as an institutional inertia in the public sector. So this is my tentative answer to the key question as a closing remark. I believe PFS works as a collaborative and communication platform for impact, solidarity, and changes with public sector. But for further promotion, we have to find a better solution and enable us the option to address to these challenges and the barriers for the promotion of SIB. Thank you.
Thank you very much, Mr. Toda. Again, a very interesting presentation and very useful information for us, for all of us and the participants. Yeah, I think that it is interesting that the focus of this instrument is on the outcomes and the results. In that, it has some similarities with the sustainability, financial instruments like green bonds that they focus on a particular segment of the economy, and the results need to be verified. So I see some very interesting similarities. It seems to be like a very good tool for governments. And we are going to the final presentation, and I apologize, we are running a bit out over time, but we are going to have Ms. Luyin Gan from HSBC. HSBC was a joint has a joint book runner on India's first sustainability-linked bond for Ultratech cement, which was well received by both conventional global institutional investors and ESG-focused investment. HSBC was also a joint book runner on Bank of China's first sustainability-linked bond, whose use of proceeds is to support sustainability-linked loans. Globally, HSBC ranks top 5 in terms of volumes of sustainability-linked bonds issuance in Q1 2021. How does HSBC perceive this new type of sustainable debt? When do you expect to see more sustainability-linked products come to market? What are some of the challenges in this space? What sectors are yet untapped and have potential for issuance of sustainability-linked loans or sustainability-linked bonds? The rise of sustainability-linked bonds has so far been mostly used for green development. How likely do you see it wider use for social development? And what is HSBC experience with sustainability-linked loans? The floor is yours, Ms. Gan.
Thanks a lot. This is Luyin from HSBC. I think we are overrunning a little bit, and then I think I will keep my presentation short. And then I think many of the great content about the sustainable capital market has been covered by Dr. McBrain from the MAS. So I think I don't need to repeat all those stats. So maybe go to the next slide. I think many speakers has been talking about the climate challenge and the lack of funding. So we do need a substantial amount of funding in order to bring our current status of decarbonization from where we are at to net zero by 2050 or 2060. So I think many speakers also talk about the roles of public finance, which is actually really important here. But I think also there are many of us are actually recognizing the private market, and most notably the capital market are also have a key role to play. So in the capital market on these slides, we mainly list out the key tools in our toolbox, which would be able to help fund climate challenge as well as the sustainable development. So in the red box, you can see that it is called user proceed approach. So this means that the financial instrument that with the green, social, transition, and sustainability label are actually the ones that which would earmark to green project, which would fund environmental benefits, for social project, which would bring the social benefit, or a combination of both, which would be a sustainability bonds or loans. And on the gray box is actually the sustainability linked structure, where the user proceed has no restriction. It can be for general corporate purpose, but the bond coupon or the loan margin is actually linked to the sustainability performance of the issuer. So we call them sustainability linked bonds, SLB, or sustainability linked loans, SLL. So we understand that these two broadly approach are actually able to be applied on a wide range of capital market instruments. The most that we've seen in the market now is definitely the bond market and the loan market. but we are also increasingly seeing the green or the SL label being applied to equity. For example, green M&A, where you are acquiring a pure green company, or a trade finance, where you are able to help your supply chain to enhance their sustainability performance. So I think we are seeing the capital market increasingly adopting either the use of proceeds or the sustainability link feature in order to channel the funds to support climate decarbonization, climate as well as sustainable development. The next slide, please. Then this is a quick stat on the sustainable bond market. I think Dr. Mabring has mentioned already. So I just quickly mentioned a couple of key stats. So the sustainable bond market is well on track to reach $1 trillion issuances in 2021, which is an absolutely fantastic growth rate. Consider that we grow from only about $50 billion about 5 years ago. And then another key message I would like to mention here is that in Asia Pacific, if you look at the percentage of sustainable bonds versus total bond, this percentage is 15.2%. This means that more than 1 bond out of 10 bonds in the Asia Pacific market is with a sustainable label. So this is no longer a niche market, but it's actually quickly going to mainstream. And then if we look at some of the key market in Asia Pacific, for example, India and Korea, you actually see this percentage is as high as 40%, which means that 4 bonds out of 10 bonds issued in India or South Korea in 2021 are actually coming in sustainable format. In Indonesia, Hong Kong, Singapore, Malaysia, this is about 10–20%. Lots of room to grow, but it is actually quite impressive. And then within the family, then a substantial percentage of them, it is in the sustainability linked format, is about 7%. So this is going from a 0 about a year ago, and then about 7% of the sustainable bonds are in sustainability linked format, which means that there is no restriction on the use of proceeds, but the bond coupon would be linked to the sustainability performance. And then if we move to the loan market, I think the portion of sustainability link is actually even larger. Next slide, please. So you can see here that if we look at all the green loan and sustainability linked loan SLL in 2021, you can see that the dark black bar is about SLL, and then the red bit is about green. So you can see that globally speaking, about 90% of our sustainable loans are actually in SL format. So this is again showcasing this widely applicability of the SL product, as well as the great support from both the banks as a lender and the corporate and financial organization who, as a borrower, they are quickly adopting to the sustainability linked format in order to put some of the impact KPI and then linking to the result to the economics of the instrument. Next slide, please. So on this slide is a quick comparison about the two approach, whether you use a proceed or sustainability link. I won't go into details here, but this is mainly showcasing that the advantage of some of the use of proceed instrument is that because many issuer would like to see where their money goes, so that type of instrument where you can clearly identify the project are actually quite attractive. But on the other hand, many of the issuer, they don't really want to go into the hustle about earmarking their green project and social project. Instead, they are willing to put the money against the outcome of their sustainability improvement. So the SL structure, it is also very suitable for them. Next slide, please. This is again some of the key instruction of the SL. I won't go into detail here to save some time. Next slide, please. On here, I actually want to take a slight step back about the sustainability link versus user proceed. On here, we would like to show you some of our interesting finding for some of the sustainable and social bond that we have seen in the market in earlier 2021. So I think many speakers here has mentioned about the climate challenge. This is indeed at the forefront of the international policy discussion, for example, at COP26. But what I would like to highlight here is that the social development, it is actually also a very important part of a sustainable development, sustainable society as well. So many of our governments, our corporate, and as our financial organization, when they focus on improving their climate performance, the social elements within the wider climate spectrum are actually their focus. And then on here, you can see that I list out two of the government in Southeast Asia. One is for government of Malaysia, the other one is Republic of Indonesia. These two are actually the pioneer in the capital market in issuing sustainability bond, which is a combination of funding social project and green projects. I think many speakers talk about the central bank's key role to play in terms of policy setting, in terms of regulation, in terms of governing against greenwashing or social washing. I think I fully agree with that. And I also want to point out that the central banks and the government also have another very important characteristic to play, is that they are actually the pioneer in the capital market. So for example, government of Malaysia and Indonesia, they issue government sustainability bond in the capital market, which is a very good example for their the corporates and financial organization in their own country to follow. So for example, government of Malaysia, they issued their inaugural sustainability sukuk earlier this year. Many of those, actually a large percentage of their user proceeds are actually to social projects. For example, supporting the quality education, supporting providing healthcare to disadvantaged community, especially under the COVID circumstance. So we see that it is extremely impactful, especially in the developing market context, about on one hand, you are supporting the climate development and decarbonization. On the other hand, you are actually improving the living standard of your community, which actually would in turn support a more sustainable development of the society. And then for the Republic of Indonesia, they issued their inaugural SDG sukuk, SDG bond earlier this year as well. And then many of those proceeds are actually going to support some specific industry, for example, the fishermen. So they have specific program to help the fishermen to improve their living standard, improve their access to education, to healthcare, as well as to teach them some basic and very useful skills on how to manage the impact about their everyday business, for example, fishing. So we just would like to highlight here that there are many Asian Pacific governments are doing very well in terms of supporting the social development, at the same time when supporting the climate challenge as well as decarbonization. And some of the corporate, for example, Korea Expressway, that some of their bond proceeds are actually support the buyers where they would not be able to pay some of their rent due to COVID, especially the SMEs. And then this bond is partly to support that. And then if we go to the next slide, then we have one example from the Axis Bank from India, which also issued a sustainability AT1 bond earlier, that many of the proceeds are actually supporting the lending to companies in the deprived area as well as SME. So these are good examples where we see that the sustainable finance are supporting both the social side as well as the green side. And then on the bottom part of the slide, that we would like to introduce two very innovative structures. This is SLB, clearly linked to our discussion point about sustainability linked feature. So these are the ones that not only have the climate as the KPI, for example, greenhouse gas emission, which is quite well known in the community of the investor, but these two, they are actually pharmaceutical companies. They also incorporate social KPI into their bond. So for example, the number of patients they reach, the number of therapy and the new treatment that they are able to introduce to the local community. So we see that investors are increasingly accepting the SL structure, not only linking to the climate KPI, which is extremely important, but also linking to the social KPI, which is actually even a wider impact instrument. On the next slide. And then this is a loan situation. It's an SLL. It is a loan to a hospitality company in Hong Kong, which is in Hong Kong dollar. So some people, the KPIs of this SLL, it is about the environmental performance, about the hotel, for example, the water usage, the energy usage. So this encourages the issuer to be more energy efficient, more resource efficient in their daily operations. But this SLL, I also see another really good impact is that the hospitality industry is actually facing quite a lot of challenge under the COVID-19 situation because the travel has been restricted. So their business has been under huge pressure financially as well as socially, because the hospitality industry actually employ a large amount of employees. And many of them are actually relatively lower paid job and relatively from the disadvantaged community. So by taking an SLL, this gives the issuer, the borrower, some of the financial incentive to improve their sustainability performance, but it also offers some financial incentive for the issuer in order to stay in business, in order to continue to provide employment opportunity to the local community. This is also impactful both in the climate as well as the social angle. So I think that's actually my sharing today. So would like to sum up is that we increasingly see the sustainability structure to be part of the capital markets, and we would like to continue to see more. And then I think there are many policy makers and from the audience today, we would like to see you getting even more active in supporting the sustainable development, sustainable finance market in order to fund a more sustainable society development. Thank you.
Thank you very much, Lu-Ying. A very, very comprehensive presentation. I appreciate it very much. We really are over time, but we can entertain a few questions. Some of our speakers, unfortunately, need to leave. Some of them already left. But in case there is any question for the floor, this is your opportunity. We have just a few more minutes. Just raise your hand and let me check the participants. If there are no questions, well, I do have a question. Let me use my moderator privilege. I'm very interested in the sustainability-linked bonds and loans. I've been working mostly on green bonds, social bonds, sustainability bonds that have this use of proceeds approach. Right. I'm interested about the KPIs. Are these KPIs set by the issuer, or there are some guidelines about the KPIs, or are they linked to any taxonomies? I just would like to know either from Darian or Yulin, please.
Perhaps, Lu-Ying, would you like to speak? I would probably refer back to what we did at Thai Union when I was working for Thai Union. But Lu-Ying, from your perspective, would you like to address that?
Yeah, maybe Darren, you can go first and then I can supplement.
Okay, so from a corporate perspective, we set the KPIs and SPTs based on the issues that were most material to the corporation, as well as those that we had good ability to measure and track performance and show that there was a material outcome over time. And so there were some, if I gave an example, some social issues that we were working on as a corporation, but it was very difficult to get a good SPT that we could really track and measure that showed impact, and we're trying to link them to the Sustainable Development Goals. So it was within overall frameworks, but definitely linked to what the corporation was doing. Lu-Ying?
Yeah, I fully agree with Darian's comment. So I think internationally there is sustainability-linked bond principle and sustainability-linked loan principle, which give us high-level guidance on what kind of KPI and SPT that we should choose. But I think Darian correctly mentioned each corporation actually face their own business nature as well as constraint. So in order to set up KPI which are material, core, and relevant to the business, and set up SPTs which are ambitious but yet still practical, it is actually quite a difficult task. So I think HSBC as the structuring advisor, we really want to work with all the issuers and then offering our expertise and our observation in the market in order to help them to choose a suitable KPI and SPT. And I think regulators like MAS, I think they're also organizing many of the useful individual events and guidance on helping the company to at least start from collecting the ESG data. So in order for them to tap the sustainable finance market with more data sets. So I think this is a new market. It is growing extremely fast, and then we need many of stakeholders from the market to work together in order to make it a robust market, and then as well as the regulator to continue to guide us, so it make sure that there is no greenwashing, social washing, that kind of not ethical structure in the market. So I think we need to work together more in order for the market to develop its depth and breadth.
Okay, so basically the issuer selects the KPIs, right? Either a corporate or a sovereign, but there still has to be some third-party verification or something to ensure that it complies with whatever standards are in use, right? So that's my understanding.
Yeah,
okay.
That's correct. So it is called external review. So it is actually a separate industry. And then I think MAS has also been quite active in supporting the development of the external reviewer in Singapore as well as in Asia Pacific, in order to offer tailored service to Asian Pacific issuer to express their independent opinion in order to help investor and the lender like banks to base their opinion on.
Okay, thank you so much. We have Ulrich. Ulrich, go ahead, please.
Yeah, thank you. So I posted the sustainability principles from the International Capital Market Association in the chat. And the World Bank has developed a platform basically for KPIs for sustainability in bonds. They should be published relatively soon. So it's trying to facilitate identifying what KPIs could be used for SLBs and so on. So trying to build the market. Thank you.
Thank you. Thank you very much, Ulrich. Any other comment or question, colleagues? Anyone from the floor, please raise your hand. I know it's a bit late. People probably want to go home. I see a hand, but I cannot see who you are. Please go ahead. I cannot see your name.
Thank you. This is Argan from Iran.
Yes, go ahead, please.
Can you hear me? Thank you very much. It was a very good session, and I really thank you for all of the presenters for very excellent presentations. I have just a comment. Maybe some can have response to that or not. When we are talking about the central banking and central bank responsibility for financial inclusion and microfinancing and different and a broad area of banking, which can include, for example, social banking and something like that. We are facing with very different clients, and we want to have these kinds of banking for them to engage them in this area, and also so they should benefit from this banking. So my question is about the structure of central banks which are engaged in these kinds of banking and financing. And for example, when we have a central bank and when we want to have financial inclusion, social banking and something like that, we need to connect with development banks or microcredit funds in a country. So is it any good practice that can introduce a mechanism or a structure under the central bank which can connect with these development banks and introduce these kinds of central banking? For example, agriculture banks can have this opportunity and capacities to connect with the microcredit funds and development banks in some countries. So maybe the connection and relation between central bank and main agriculture bank in the country can organize this structure. You mean I'm talking more about institutionalizing this approach, and want to know more about these kinds of practices that some of the countries may have. Because in Iran, we are thinking about some kinds of structuring, because we have different kinds of banks in our country. Many of them are development banks, and the other have the classic services. So this is important to introduce this structure in a system that is related to all of these fiscal and monetary policies. Thank you. Over to you.
Thank you. I guess either Peter or Ulrich. Please go ahead, whoever wants to answer.
Let me start then. I think it very much depends on the institutional structure in the particular country. What is the legal relationship between the central bank and the other development banks? Do those development banks are they under the regulation of the central bank, or perhaps the Ministry of Finance instead? And typically, let's say if you take the example of India, what they've done to foster financial inclusion by the state banks is to essentially set minimum lending quotas, let's say for small and medium enterprises or disadvantaged groups of various kinds, so that I'm not exactly sure whether that directive comes from the central bank or whether it's part of national legislation. But ultimately, what you need is a national financial inclusion strategy, which includes the central bank and the development banks and for example, the microfinance institutions. And it will depend again who regulates the MFIs. Is it the central bank or some other financial regulator? So that, for example, if you look at the case of Indonesia, there are again various types of banks which are, or other kinds of non-bank financial institutions which are in the sort of financial inclusion space, but they're regulated by several different regulators who may not be in touch with each other that much, so that there does tend to be, in that case, kind of a regulatory race to the bottom. So it really does depend on the overall regulatory structure and the assignment of roles between the central bank and perhaps other financial regulators or other ministries.
Thank you, Peter.
Yeah. Maybe just to quickly add to that, clearly there's a multitude of different actors in the financial system, traditional banking institutions, but also, as Peter also mentioned in the presentation, non-traditional providers, so kind of fintech and so on. I think what is important that policymakers, so be it the central bank, the supervisor, Ministry of Finance, other authorities, really take a holistic approach and also look at how they can shape the market development. So I think it is always important also when it comes to sustainable finance, green finance and so on, to see that markets are not static. They can develop, and certainly there's a strong role for commercial providers, but in some cases there's also a strong argument for having publicly owned development banks and so on with a specific mandate. So it really is a mix of institutions, and as Peter said, we need to have really kind of a national strategy for inclusive finance and for green finance, and that's why I'm suggesting we should kind of look at inclusive green finance together. Thank you.
Thank you so much. Any other question, participants? Otherwise, I think we should close. We are very late. Well, there is one. Okay. Please identify yourself and ask your question, please. I cannot see your name. Oh, David. Yes, please go ahead. I think this is the last question, colleagues. Yes, David, please unmute yourself. We cannot hear you.
Yeah, thank you. My name is David Baguma. I'm from Uganda, but I'm interested in the Asia Pacific region. I needed to ask the expert, any that could come up with the response. To what extent has the bank overall responded to the shocks caused by the COVID pandemic in purchase of vaccines and then and the related climate and the COVID-related responses that affect businesses as a whole in the region?
Anyone want to answer from the panelists, please? Any volunteer?
Well, as I mentioned in my presentation, central banks have I think one of their main reactions has been easing of financial conditions, and particular lending programs for financial institutions, also SMEs, that kind of thing. In terms of direct purchase of vaccines and things like that, I think that's on the whole by governments as opposed to central banks. So I think it's the main role of the central banks in the COVID-19 situation has been to support the overall economy through easy monetary policy and these more targeted lending policies.
Okay. Do you want to add anything, Ulrich? I think we are fine. David, this is okay. Okay. Sorry, colleagues, participants. We need to close. Unfortunately, we're a bit late. This was a fantastic session. I really want to thank all the speakers for very, very informative presentations. I think that the topics covers are very forward-looking overall. We are looking really into the future, in terms of monetary policy, into the, sustainable market financing developments. So this is has been an exciting session for me. I hope our participants feel the same. And this is only a beginning. It's not the end of it. These topics are going to be there for a long time. So I'm sure that we'll have new opportunities down the road to continue this conversation. I want to say, again, thank you for all my colleagues, for the preparation of this session, for the logistical support. My role was quite easy, just to come and moderate the session. So I'm very thankful to my colleague from my division, from MPFD. Finally, I would like to say to everybody that I believe that the session has been recorded, so it will be posted in the website and along with all the presentations. So please visit again the website if you want to, sort of read, see again the presentation or look at the video. Thank you very much. Shweta, you want to say any closing remarks?
No, just one thing to remind all the participants, actually, all our speakers rather, that we are still working on our survey, the chapter where your inputs will be included, will be sent to you for some comments and inputs later on. Okay, so your job is not done yet, just to remind you. But thank you so much for all the inputs. Yes, and thank you, Alberto, for moderating. Yeah.
No problem. Thank you, everybody.
Thank you. Bye-bye.
Bye-bye.
Thanks very much.
Wherever you are. Bye-bye.
Bye.